Okay, so picking up with the second, with this next part of the chapter, Learning Objective 5, explain the concept of independence. This is one of the higher priorities in the chapter because this is one of the more concrete ways or set of rules that are out there. A lot of importance is put on independence. Not every circumstance is in the rules, and we'll talk about an example of that, but we will spend some decent amount of time working through this idea of independence. Okay, so what are we thinking about when we say independence? We're ultimately can think about it in two ways: independence of mind, which is the independence we really care about, right? We want to make sure that you have an independent perspective from, especially when we're talking about auditors, you have an independent perspective relative to the client and relative to the audit you're doing. Like you have an open mind, but you're also skeptical, right, of what the managers are saying. That's what we ultimately care about, but it's really hard to get to that, right? Because how do we understand the thoughts of someone, right? We're not telepathic, so we need to focus, or the rules end up focusing on independence of appearance, right? And how does it look? And so we need both. We need the independence of mind because that actually impacts the work we do. We also need independence of appearance because that impacts the perception that we are independent, right? And remember, we said credibility is our ultimate product, and so if we are perceived to be impaired in our independence because we're lacking this independence of appearance, then now all of a sudden, even if we have independence of mind and we do a good job, now all of a sudden people don't believe us, right? And so you really need both. So the conceptual framework for the AICPA is basically used to evaluate these threats, and it considers, similar to what we talked about before, whether the code directly addresses the threat, and if it doesn't, then do we have adequate safeguards. Now we're just taking that framework and now we're applying it specifically to independence. Okay, and the ultimate perspective is whether a reasonable person, if they knew everything that was going on, would evaluate the issue as a unacceptable risk that the auditors have a failure of independence, right? And so that's a kind of a convoluted way to say, would a reasonable person conclude that you're not independent? So what are some threats here? It's actually the same set of threats from before, so I'm not going to go through all of those. There's some additional examples here, but those are basically our 6 threats that we talked about before to independence. Some of the safeguards, again, the same set of generic safeguards that we talked about before for the whole code applies to independence. So again, I'm not going to go through each of those. You can see some additional examples there for independence. And so, again, the same framework applies to our situation for independence as it does to the overall conceptual framework. So, again, I'm not going to get to that. But again, I guess I will say that again, the focus is whether independence is impaired or independence is not impaired, right? That's really kind of what we're trying to decide on in this section. Okay, so we can think about this from the perspective of individuals, like for example, an individual auditor versus the audit firm. And so we'll talk about this idea of individuals versus firms and their independence. You don't necessarily have to have every individual in the firm be independent, right? The firm has to be independent, excuse me, especially for attestation services. But ultimately, not every individual in the firm has to be independent for the firm to be able to provide and engage a service. Okay, and so the individuals that do have to be independent, though, are covered members. So in a given firm, we're going to have, for a given engagement, a set of covered members, and then there'll be everyone else. And so we're just going to focus on covered members. Just think about this from perspective of one of the big four. I mean, they have hundreds of thousands of employees throughout the world. Chances are some of them will not be considered independent, and the key is we just won't let them provide the engagement, right? So who would be considered these cover members that we need to make sure that they are independent of mind and of appearance? And so obviously if you have an attestation engagement, then any staff that are working on that engagement, and I don't mean staff as in the lowest level, I mean any individuals, whether they're associates, seniors, managers, senior managers, partners, those are clearly covered members because they're the ones providing the service. Anyone who could influence the attestation engagement. So let's say you had an individual who provided some outside work, and they can influence some of the work that's being done. They provide some advice and some direction for the engagement team. Then they would need to be independent. A partner in the office in which the partner in charge of the engagement practices, right? So what does this mean? So let's say we have in the Charlotte office, let's say there are 10 partners, right? And we have an engagement. We said Lowe's is an example of a firm that's being audited, in this case by Deloitte. And so let's say in the Deloitte Charlotte office, the partner that's on that engagement, clearly they're covered in the first item, right? They're covered as staff working on the engagement. But let's say, I'm just going to throw out a number. Let's say there's 50 other partners in the office. It may not be that high, but all those partners in the Charlotte office would need to be independent as well. They're considered covered members. Okay, and so they're at that level of leadership in the firm, and so the idea is that they need to also be independent. Okay, then what about partners that provide some non-attestation services to the client? Let's say we had some other partners in the Charlotte, let's say they weren't even in the Charlotte office. Let's say there's some partners in the Greensboro office or the Atlanta office, for example, and they're doing some non-attestation work. And so the extent of the amount of work kind of impacts this, and we don't need to get into the specific rule, but if it's a substantial amount of work that they're doing as far as non-attestation to the client, and Deloitte is the auditor of Lowe's, then you can't have a partner that's providing a substantial amount of non-attestation work you can't have a problem with their independence, right? They have to be independent as well. And so there's a threshold there, and it doesn't matter exactly what the threshold is, but the idea would be if they provide a substantial amount, then they also need to be independent. And then lastly, the actual firm itself, in terms of like its investment in the employee benefit plan. So let's say they have a retirement plan, and they invest in individual stocks. Well, they can't invest in Lowe's if they're going to be providing an audit to Lowe's, right? So they could invest in mutual funds that might have a share, of Lowe's, but they would not be able to invest directly, and so they need to be independent as well. And then lastly, any entity that's controlled by any of these. So let's say you had a partner that also owns an advisory firm, and they provide some advisory services, then that entity would need to be considered independent as well. All right, so some additional requirements here. How do we know if we're independent? Well, you can't own more than 5% of the client's stock, right? So that would be considered a block holder, right? A significant shareholder at that point, and so no one in the firm can do that. That's for all partners and staff. and the partner or employee can't be a director, officer, employee, etc. of a client, right? So you can't have partners that are also directors of the audit clients. Okay, it doesn't matter if that partner is in another office. It doesn't matter if the employee is in another office and they don't never work on the audit. They can't be an employee essentially of the client, right? That would create an independence problem. And then lastly, there are issues around, or not lastly, sorry. That's for all partners and staff in the audit firm. Now, specifically for the covered members, so how do we decide on independent versus not? So all direct financial interests are prohibited for those covered members, right? You can't own any direct stock in your audit client. You can own mutual funds that have shares of your client, but you can't actually own direct financial interest. If you have a substantial amount of indirect financial interest, then that's also prohibited. And that would be an example where you do own a mutual fund, but it becomes a substantial amount of stock that you own of that mutual fund, which when you translate it to the percentage that they invest in the audit client, does that become a significant amount? And so the answer would be no. Okay, and then gifts can impair independence. Like we would go out to lunch, for example, with our clients, but we can never let them pay for our lunches, right? That wasn't something we were allowed to do. So this is just a kind of a table, if you prefer tables, of the direct versus indirect and what you're allowed to have versus not if you're a covered member. So here's just some additional examples here that or actually another table that kind of helps lay out if you're covered versus not covered. Again, this is a good figure to study that kind of helps separate out what you can do in these, whether you're a covered member of the audit, covered member in the audit firm, or a not covered member. And so, again, this is just a nice little summary of these last couple slides. Now, what about family members and relatives, right? So we were talking about financial interests before. Now, what about relationships, right? And so, if you have an immediate family member, a spouse or equivalent, or a child, or a dependent, then you are considered impaired. Your independence is considered impaired, right? Unless you have some other, there's some exceptions, but ultimately the general rule is if you have an immediate family member, then especially that's in a key position, then you're considered impaired. If you have other relatives, like your parent, your brother, sister, then ultimately the focus is, are they in a key position, right? Or is there a material financial interest of the close relative, right? Let's say your brother is a CFO, right? That's a key position. You'd be considered impaired. Let's say you have your father owns a lot of stock, a pretty substantial amount, and you know about it, then that would be considered an impairment, right? If you happen to have a sibling you never talk to and they have a substantial amount that's invested and you don't know about it, then that would not be considered an impairment, right? Because the idea would be, is there any reason why you would want to not be objective in performing the work, right? So if you're not aware of something, then that's not impairing your independence of mind. Other relatives and friends, there's a lower hurdle, and again, that kind of comes back to our catch-all of how substantial is the threat, and then are there safeguards in place? Don't we consider this a threat? Oops, sorry. So what we consider in a key position. So if you have responsibility for significant accounting functions, that's a key position. Preparation of the financial statements, obviously. If you have an ability to exercise influence, or if that person has the ability to exercise influence over the financial statements, and there's a big list of individuals that are there, all those would be considered key positions, and then that kind of triggers, again, that's where you oftentimes, that means you're going to have, if you have a relative in a key position, for example, that usually means you're going to have to get off of the engagement. You're not going to be able to be staffed on that engagement. Okay, so now the next learning objective, think about independence rules, especially are there any additional ones related to public companies relative to auditing a non-public company? Okay. So Sarbanes-Oxley restricts a certain number of services being performed if you're the auditor, right? So if I audit Lowe's, what other services can I not provide to Lowe's? Okay, and there's a set that Sarbanes-Oxley said, we think that there's too much conflict of interest here, and so they just exclude them. Now, if it's not a publicly traded company, then this doesn't apply, right? But this is for publicly traded companies. If you want to do the audit, the financial statement audit, here's what you can't do as well. You can't also do bookkeeping services. That kind of gets back to that self-review threat. How are you going to criticize the accounting if your firm did it, right? That's prohibited. Designing the financial system, like the accounting information system, SAP, or designing all the controls. How can you provide an adequate review of those if, again, you had a significant hand in designing and implementing it? Appraisal or valuation services would be another one. So that gets to some of the things we have for fixed assets. So if you provide the services that come up with the valuation for those, how are you going to come back later and audit that objectively, right? You can't. Actuarial services, since those can impact some significant estimates like pensions, then if you provide those services to help estimate all the things that go into the pension accounting, then how are you going to, again, be objective to audit that? So Sarbanes-Oxley says you can't do that as well. Internal audit outsourcing, so if the firm asks you to help with some of its internal audit, which firms sometimes do, then how can you come back later, and since internal audit is a substantial part of the internal control system of a firm, how can you come back and evaluate the internal controls over financial reporting if your firm had a hand in actually executing that oversight in that part of the internal control system, right? So again, you're not allowed to do that. Management functions, human resources, that kind of gets into that management participation threat we talked about earlier. Investment services, so if you're help managing for example, the retirement system and the retirement fund, again, how can you be, the idea would be that you would not be able to be independent in providing the accounting. If you're providing legal services or other expert services, then again, the idea would be, since those legal services often impact the transactions you take and the ways in which you structure those transactions, then that could impact your ability to be independent. And then lastly, certain tax services. And largely the tax services, what it's come down to is the board of directors often has to approve the accounting firm providing both the audit and the tax services. So those, again, are all services prohibited if you want to do the financial statement audit as well. So the integrity and objectivity rule, this applies to all the members of the AICPA and their services. So again, kind of working through some of these different rules now in the framework. You can violate it by basically participating in making materially incorrect entries, failure to correct financial statements that are materially false, and signing off or having others sign off on materially false information, right? So that's kind of a general rule around integrity and objectivity. And again, these are the rules. We kind of had seen a slide a little while ago about these different rules. This is just giving you more detail around these, around general rules, general standards. We talked about professional care and some of these other things. Compliance with the standards rule. There is kind of these different authoritative bodies, what they're in charge of within the AICPA or the FASB or the GASB or the ASB, and then what kind of rules. So this is, if you ever kind of get confused around the different acronyms and the different standard setting bodies that are around, then this would be a good go into review. I'm not going to go through this in detail though. And again, kind of working through some of these other rules. We have their AICPA has rules around principles. Well, obviously, GAP is the ultimate set of principles we're going to look at through the FASB or the other standard setting bodies, depending on the actual service being provided. This acts discreditable rule is about what you need to do as far as handling the records of the client, as far as what can be kept by the auditor, what needs to be returned, that kind of thing. And so this kind of guides a lot of the document retention. Contingency fees, we talked about this before, but if you're doing audits or review of financial statements, then contingency fees aren't allowed. Other fees related to commissions and referrals. And so it used to be this advertising rule for a long time. The profession did not want accountants to advertise, right? They wanted their reputations to do the advertising for them, but that was relaxed a while ago, and that's why you see advertisements from accounting firms. But for a long time, they were not allowed to, because the profession felt like it was not helpful to try and do these marketing gimmicks and slogans and things like that, and so they weren't allowed to. Now they are. They just can't have information that's false or misleading. Obviously, there's confidential client information as well. There's rules around that. Pretty open to the form of organization and names that are allowable in the AICPA. Those are some of the different practice structures that are available and what you can actually provide. And then there's some rules around preparation, right? If you're a CPA and doing preparation. And then lastly here we have the IIA's Code of Ethics. I'm not going to go through these because it largely mimics a lot of the stuff we talked about with the AICPA. Just know it's out there, and if you become an internal auditor, you'd have to adhere to the to this Code of Ethics. Okay, so I'm not even going to go through these.